I called Pete last Sunday afternoon. It had been a year and change since we sat down at his kitchen table and worked through the 8 topics from my last video. Insurance, taxes, credit, estate planning, the HSA he'd opened that week. The whole list. I'd been wanting to check in and see how the system was actually running. Pete picked up and we talked for about 40 minutes. At the end of it, he said something that stuck with me. He said, "Tom, the strangest part is how rarely I think about money anymore." He had opened his bank accounts maybe 4 times in the whole year. The retirement balance got checked twice. Since the Saturday afternoon we set it all up, he had not moved any money manually once. His savings rate had held steady at near 20% of his gross income through 12 consecutive paychecks, including the month his daughter got married and the month he had a surprise dental bill, because the system had been built so that the saving happened before he could see the money or decide to do anything with it. This is what I want to walk through today. Not the 7 truths from the first video, and not the 8 topics from the second one. The system that takes all of that knowledge and turns it into something that runs without you for the next 30 years. 3 transfers, 4 accounts, and 1 weekend of setup work. After that, you mostly just live your life, and the system does the building in the background. This is the missing video. Knowledge by itself does not build wealth. A system that runs the knowledge automatically does. Most personal finance failure is execution failure, not knowledge failure. Today, we're closing that gap. I'm Tom. This channel is about real personal finance for normal people. No motivational fluff, no fantasy returns. Just what the math actually does over time. If that's what you want, hit subscribe. Let me start with the part most personal finance content skips because it's uncomfortable. The reason most people fail at money is not that they don't know what to do. By the time somebody has watched a few hours of YouTube on the subject, they have more than enough information. They know to max the 401k, build an emergency fund, and avoid lifestyle inflation. The knowledge is sitting right there. What they don't have is the ability to make the right decision 12 times a year, every year, for 30 years, while their brain is busy with everything else in their life. Nobody has that. The brain that evolved to make decisions about food and shelter today is genuinely terrible at making the same decision about a retirement that's 3 decades away, repeatedly, when the decision is dull and the alternative is something fun happening right now. This is not a willpower deficiency on your part. It's how brains work. The decision-making capacity you have on any given day is a finite resource, and you use it up on the immediate things in front of you. By the time you get to the abstract question of whether to move money to your investment account, your decision-making tank is empty. You do the easy thing, which is to leave the money in checking and tell yourself you'll deal with it next month. The fix is not more discipline. The fix is to remove the decisions from your daily life entirely by setting up a system that makes them automatically. You decide once when you have time and energy. The system runs the decision every 2 weeks for the next 20 years. Your daily willpower never has to engage with the question again. This is the single most important shift in personal finance, and it's the one almost nobody internalizes correctly. Here's what the working system looks like. 4 accounts doing 4 different jobs. Each one is at a different institution, and each one has exactly 1 role. The first account is your checking account. The job of this account is to be the central hub where your paycheck lands and where your daily expenses come out. This is the account that handles your rent, your groceries, your utilities, your gas, every transaction in your normal life. It's the bus terminal where everything passes through. The amount of money in checking should be roughly 1 month of your spending plus a small buffer, not more. The money is not supposed to sit there. The second account is your employer retirement plan. For most people, that's a 401k or a 403b. Its job is to capture pre-tax retirement savings before the money ever lands in checking. This is the single most important automation in the entire system because it happens before you ever see the money, which means your willpower never engages with it at all. The third account is a high-yield savings account at an online bank. Its job is to hold your emergency fund and any short-term savings goals like a planned vacation, a future down payment, or a house repair fund. The interest rate on this account matters because the money sits here for months or years. As of mid-2026, top-tier high-yield savings accounts are paying around 4% in interest, while the big national banks are paying about 1/10 of that. The fourth account is your brokerage account, where your long-term investments live. This is where the Roth IRA contributions go, plus any taxable investing on top. Most people open these at Fidelity, Schwab, or Vanguard, none of which charge fees for basic accounts. Its job is to hold the money that's compounding for decades in low-cost index funds, while you do something else with your life. 4 accounts, each at a different institution where possible, because keeping them separate makes the money harder to accidentally spend, which is the entire point. 3 movements of money make this system run. None of the 3 requires you to do anything once they're set up. The first transfer happens before your paycheck even reaches your checking account. Your employer payroll system is configured to send a fixed percentage of every paycheck directly into your 401k or 403b. This is the most powerful automation in the system because it does not go through your decision-making at all. The money is gone before you see it, which is the only structure that reliably defeats the brain's preference for current spending over future saving. The percentage to choose is whatever gets you to the maximum legal contribution by the end of the year, divided across your paychecks. For 2026, that ceiling is $24,500, plus an additional $7,500 catch-up contribution if you're 50 or older. If you can't immediately hit the maximum, capture at least your employer match, because that's the highest return move available in your entire financial life. Then increase the percentage by 1 or 2 points every January, automatically, until you reach the maximum. Many 401k plans have an auto escalation feature built in that raises the percentage for you each year. Turn that on. The second transfer happens the morning after your paycheck hits your checking account. Your bank is configured to pull a fixed dollar amount from checking and deposit it into your high-yield savings. This is your emergency fund being built and replenished, plus any sinking funds for big planned expenses. The dollar amount depends on what you're saving toward, but a useful default is whatever it takes to maintain 3 to 6 months of expenses in the account at all times. If the account is below the target, the monthly transfer is larger. Once you hit the target, the transfer shrinks or pauses. The key is that the transfer happens automatically the day after payday, not at the end of the month after you've spent everything else. The third transfer happens the same morning. A second automatic pull from your checking account moves a fixed amount into your brokerage account, where it gets deposited and then automatically invested into a low-cost index fund or a target date retirement fund. The amount depends on your situation, but a reasonable starting point is enough to max your IRA each year, which is $7,500 in 2026 divided by 12. That's $625 a month going into the brokerage automatically. These 2 transfers, fired the day after payday, are the heart of the system. The order matters. You pay your savings and your investments first. Whatever is left in checking is what's available for spending that pay period. Most people do this backward. They pay their bills, they spend on whatever, they look at what's left at the end of the month, and they save that. The end of the month is always less than the beginning, so the saving never happens. Reversing the order is the entire trick. There's exactly one decision the system asks you to make each year. The rest runs without you. Once a year, in early January, you sit down for 90 minutes and run an annual review. You look at 3 things. Did your income change? Did your expenses change? Are your contribution percentages and dollar amounts still set correctly given those changes? If you got a raise, you update the 401k percentage upward so the raise doesn't drift into lifestyle. Expense changes from moving or having a kid mean updating the household budget while keeping the savings rate flat. When the IRS contribution limits adjust for inflation, which they do most years, the dollar amounts on your auto transfers need to update to keep maxing the available accounts. That's the entire annual decision footprint, 90 minutes once a year. After that, you go back to not thinking about money for another 12 months while the system runs. This is genuinely the whole decision load of a healthy financial life, once the architecture is in place. Most people experience personal finance as an endless series of small daily questions that drain their attention and willpower. The system replaces all of those with one 90-minute session per year. The difference is enormous, and it is the difference between people who build wealth and people who don't. If you don't have this system running yet, here's how to actually build it in a single Saturday. The whole project, start to finish, is about 4 to 6 hours. Saturday morning. Open the 4 accounts if you don't already have them. Your checking account at whatever bank you currently use is fine, unless it's charging you fees, in which case switch to a free option at an online bank or credit union. For high-yield savings, set up an account at one of the major direct banks. The brokerage account goes at Fidelity, Schwab, or Vanguard, whichever interface you find easiest to navigate. If you don't have a 401k at work and you have access to one, fill out the enrollment paperwork. The whole opening process takes about 2 hours of online forms and identity verification. Saturday afternoon. Set up the 3 transfers. Inside your employer benefits portal, set your 401k contribution percentage and turn on auto escalation if it's available. In your checking account interface, schedule an automatic transfer to the high-yield savings, scheduled for the day after your paycheck normally hits. At the brokerage, set up an automatic transfer from checking, also scheduled for the day after payday. Then enable the auto investment instruction so that money landing in the brokerage gets automatically invested in a target date fund or a basic 3-fund index portfolio. Do not leave money sitting in the brokerage as cash. The auto investment instruction is the part that turns a savings system into a wealth building system. Sunday morning. Update your beneficiary designations on the 401k, the IRA, and any life insurance policy you have. This takes 30 minutes, and most people skip it for years, with consequences I covered in the previous video. If you don't have a will, take another hour and use Trust and Will or LegalZoom to set up a basic one while you're already in financial paperwork mode. Sunday afternoon. Write down what you just set up on a single piece of paper. The 4 accounts, the 3 transfers, the percentages and dollar amounts. Tape it inside a kitchen drawer or save it as a note on your phone. This is the page you'll look at next January when you do your annual review. You're done. The system is now running. The next paycheck will trigger it automatically. The one after that will too. 12 months from now, you will have done none of the thinking, and somewhere around $15,000 of saving and investing will have happened in the background. This is the part of the video where the system stops sounding like overkill. Let's run the numbers for a household saving 20% of an $80,000 income split across the 3 vehicles. That's $16,000 a year going into the system, $8,000 into the 401k, $625 a month into the brokerage, some smaller flow into the high-yield savings to maintain the emergency fund. At a 7% real return on the money flowing into the 401k and the brokerage, the compounding gets impressive, faster than people expect. The first decade builds the accounts to somewhere around $200,000. By the 20-year mark, the same steady flow has accumulated around $600,000. By 30 years in, the total lands somewhere close to $1.5 million, all in real inflation-adjusted purchasing power, meaning that's the actual money you'll have when you spend it. The person who builds this system at 30 and runs it for 30 years arrives at 60 with around $1.5 million of accumulated investments on an $80,000 income, without ever having made a heroic financial decision. They just set up the system and let it run. Compare that to the person who has the same income, the same intelligence, and the same general intentions, but who never set up the automation. They make the saving decision month to month based on what's left in checking. Some months they save a lot, most months they don't. After 30 years, their accumulated savings typically land somewhere between $200,000 and $400,000. Their lifetime income was the same. Their knowledge level was the same. The system is the entire difference, and the system is the thing that compounds. The system isn't magic. It's that the system makes the right decision once and then runs that right decision 12 times a year for 30 years, without you having to be heroic in any single moment. That kind of consistency, multiplied across decades, is what builds wealth. Nothing else does. When I called Pete last weekend, the thing that came through wasn't satisfaction about his net worth growing, although it had been. The thing that came through was relief. He said he hadn't realized how much background mental space the money question had been consuming until it stopped. He'd been quietly, constantly thinking about money for 30 years. Whether to save, whether to spend, whether the next bill would land badly, whether he was doing enough. None of it had been productive thought. It had just been a low-level hum of anxiety running underneath the rest of his life. The system replaced the hum with silence. Not because the money problem went away, but because the system was solving it without him having to participate. The decisions were happening, the money kept moving, and the accounts grew. He was free to think about other things for the first time in his adult life. That, more than anything else, is what a working personal finance system buys you. Not just retirement, not just wealth, the mental bandwidth back. The brain space that was being consumed by the same 50 decisions every year, freed up to do something else. The 7 truths from the first video are what you need to know. The 8 topics from the second one are the supporting infrastructure around that knowledge. The system in this video is what makes the first 2 actually do their work in real life. Build it on one Saturday. Run it for 30 years. The math takes care of the rest. Drop a comment with which of the 3 transfers you're going to set up first. I read every one. See you in the next one.